This is the Insider's Guide to Real Estate, and I'm your host, Victor Norman. Today we talk mortgages. We'll go a bit of history on the housing crisis. We'll talk about some opportunities for first-time homebuyers, and finally end up with some major changes to closing documents at the closing of a real estate transaction. To guide us through this morning is my guest, Jeremy Wonders. Jeremy is a senior loan officer with RMS Mortgage. And please join me in welcoming Jeremy to our show.
Hi, Victor.
Thanks for being here.
Thank you.
All right, let's start out. Let's history. The housing crisis, it seems to have passed, but in some areas it really hasn't. But since 2008, there have been many changes in how loans are made and mortgages put together. Let's go back in time to what was going on right before the crisis in 2008. The crisis was, we think of it in terms of major bank failures, Lehman Brothers, billion-dollar bailouts, but the root cause was really individual subprime mortgages. So tell us how that happened and what was going on back then.
Sure. I think, back in 2005 to 2008, we were probably some lending practices that were a little less lax than maybe they should have been. I think we got into a little bit of a housing bubble, and some of those subprime mortgages sort of made their way into the secondary market and in packages, and sort of there was really no way to separate the bad loans from the good loans, and so kind of steamrolled and snowballed into sort of what we ended up with.
So what was the motivation? Why was this allowed to happen? I mean, I think the part of the thinking was housing values never go down, so there's no such thing as a bad loan. Is that really behind it all?
I think that probably, money was very cheap, and we were, finding ways to, get more people into homes. Unfortunately, I think some of the lending practices and some of those products may not have been, exactly what the client and the market needed at that time. So we did have, some subprime loans sort of go bad and sort of, take the market down with it. But I think what it did do was, create a lot of change and regulation that has only served to help the lending industry over the last couple of years.
But weren't there regulators back then? Was anybody watching what was going on?
Yes, I think, there was certainly some regulation there, but I think, obviously after what happened, and everybody took a step back and sort of, put a new set of rules on, a much more conservative set of guidelines to make sure, hopefully, that something like that doesn't happen again. So, a lot of the lending rules have changed. Some of the products that were available back then are no longer available.
Right,
certain things
whole
like
concept of a no-doc loan.
No-doc loans are no longer allowed. You have to basically show all your income, show your tax returns, show everything that you make. But I think from that, we've moved towards a lot of really good changes that really do benefit the consumer. We're going to talk about a couple of those upcoming changes later on.
So part of the problem, you mentioned mixing these good loans and bad loans, and that's all a function of the government services agents, the GSEs, Fannie Mae, Freddie Mac, packaging loans together and turning them into mortgage-backed securities. And those are what really failed. And even though the subprime was only a portion of the market, the failure of those bonds dragged the whole market down. So now we have 2008. The government and these GSEs decided to close the barn door, as it were. And so they passed the Dodd-Frank bill and some regulation, the Consumer Protection Finance Board. So tell us what kinds of changes in your industry came about because of that.
So we've had a number of changes come about. One important one is relates to how the loan officers can be paid. That came in 2012, and that was to sort of level the playing field and make sure that people weren't being overcharged for rates. And another big change came with the QM rules, where we thought the mortgage industry was going to move towards all 20% down in order to get financing. That never sort of materialized, and some of the changes that did come from that were no more negative AM loans where the balance can go up, and some other changes to some of the different products.
It's just hard to believe that there actually was a mortgage product where, as time went by, you actually owed more money. You never actually paid down your mortgage. I mean,
well, yeah, it was. Banks will always come up with a good niche product to fit some needs, and some people will benefit, and some people won't be perfect for.
Right. So until the lenders and the banks, and I'm being a little cynical here, figure out ways around the new regulations, we're in a period now where I think it's safe. You can characterize them as pretty safe loans are being made.
I would say yes. The industry had sort of swung all the way over to very conservative at this point, and we're starting to see that ease back with the introduction of a couple of new first-time buyer products coming back into the market. So, we're starting to sort of come back to common sense, I think, here a little bit.
And that's what it's all about, common sense. So now there are, when people think of mortgages, there are lots of places to get mortgages. There are, the major national lenders, Bank of America, Wells Fargo, Citibank that come to mind. There are credit unions, savings banks, regional commercial banks, but then there's also private banks, private mortgage lenders, which is a company that you work for. Describe what a private mortgage lender is and how they might be different from these other types of lenders.
So Residential Mortgage Services, we're a mortgage company. We're not a bank. We're not a credit union. We're not a broker. I think the big difference for us is that we do everything locally. We process and underwrite our loans in our branches, so we have a very decentralized decision-making process that allows us to make decisions quickly and efficiently and help a purchase transaction continue to the closing very smoothly without any issues. I think having the local underwriters, appraisers, people who understand the market in Massachusetts, as opposed to sending a file out, to the Midwest where someone might process it and not really understand the true Massachusetts market, I think brings us a real advantage because we really have a good handle on our market.
Sure. And many consumers will have had very good experiences with the major lenders as well. And from where I'm sitting, a lot has to do with the individual loan officer that you're dealing with. There are all types of loan officers. So from a consumer's perspective, if we've been told and talked about on this show where it's always a very good idea to start off working with a lender, even if your home purchase is off in the future.
Yes.
It's better to start off and find out not only how much of a mortgage you qualify for, but what kinds of things you can do to improve your credit scores going forward. So let's talk about that aspect of it.
Sure, absolutely. I mean, yes, all loan officers are not sort of created equal. I mean, I'm licensed by the state of Massachusetts and New Hampshire, and I think it's important to work with a professional, and the earlier you can sit down and talk to someone about what your plans are in the future, the better, because it's going to give them enough time to maybe suggest ways to better your position, whether it's by, increasing your credit score or, setting up certain finances, to help you sort of facilitate a smooth closing. There are a number of ways that a loan officer can have a conversation with you about your unique position and goals and be able to advise you different ways that may make it easier for you to go through the purchase process.
Okay, so it's not a bad idea for a consumer to kind of interview a loan officer and get a good feeling from them. Let's talk about going back to these tightened regulations and requirements. I think it's like 90% of all mortgages end up being purchased by Fannie Mae and Freddie Mac and repackaged. And so they have their guidelines, and they're rigid. That if they're going to buy your loan, you must conform. And there are consumers out there who don't exactly conform. So what kind of options do they have? They're strong, they have good jobs, good income, but something about their documentation doesn't conform in this way. What options do they have?
Sure. Well, as at RMS, we're a direct lender for Fannie, Freddie, FHA, USDA, and Mass Housing, so we actually underwrite all those loans to their guidelines. But in some situations, you do get a borrower who has a unique situation that doesn't quite fit those black boxes of Freddie and Fannie, and in certain options we have for those buyers, usually on a case-by-case basis, but we do have correspondent lending relationships with different investors and different niche products that may allow buyers like that who may not be able to find conventional financing to sort of get an exception to those guidelines, based on a case-by-case basis.
Right. So it's important for a consumer, someone who's shopping for a loan, to be sure that the loan officer they're dealing with has access to these types of exceptions. Not that it's any guarantee they'll get a mortgage, but at least it's an opportunity that they need to know exists.
Sure, absolutely. I would always recommend that if you're thinking about buying a home, that you reach out to someone either that you have a relationship with that's had a good experience with a lender, or if you can find someone that can give you a good referral to a good lender. I would recommend calling at least one, maybe two, to see who you click with and see what kind of information you get. But you should do everything from pull and review credit to talking about what down payment options might work best for you, and as well as get some detailed information about what that monthly payment or those monthly payment options are going to look like, so that you really educate yourself on what your options are, and it's really going to give the buyer peace of mind when they go out to look at houses, to know that they really know what they can and can't do when they're out looking.
All right, now let's talk about first-time buyers, and the first thing is define a first-time home buyer.
Sure. First-time home buyer does not mean that you're buying a home for the first time. It actually just means that you have not owned a home in the last 3 years. So that would make you a first-time home buyer.
All right, so someone who lost their home through bad times in foreclosure and has managed to repair their credit, accumulate some cash for a down payment, could be considered a first-time home buyer.
Sure, as long as they're 3 years out, typically they could be considered a first-time home buyer. And foreclosure rules, depending on sort of what happened in the past, would either have them 3 or 7 years out from financing. But yes, that would be true.
But that would be something that they'd be well advised to know what their options are, where they stand.
Absolutely, yeah. Speak to a lender and sort of get the information about what you can and can't do.
Okay. So right now in this market, and I think in many markets in the state, we're seeing an absence of first-time home buyers. The market is very active at the high end and the higher end right below that, but first-time home buyers aren't around, and it seems to be a combination of they seem to be set where they are, okay paying rent, maybe they think they don't have options, and then not a lot of inventory. And you can't control the inventory, and neither can I. But in terms of misconceptions that first-time homebuyers may have with respect to their financial condition and their ability to afford a mortgage, what advice could you give them?
Sure. I think, one big thing is, in most cases, what you can get pre-qualified for a home, first-time buyer, as a single family or a condo, sometimes those monthly payments can be very close to what people are paying in rent, or maybe even less. So if you're unsure of what mortgage payment would be for you at a certain down payment, I would contact a lender and see if he can tell you what the payment is going to be and how it relates to the rent you pay now, because it may be closer together than you think.
Sure, and there still are significant tax advantages to owning a mortgage, paying interest on a mortgage, and property taxes on a piece of property.
I'm sure you probably, I would have you consult your tax accountant, but yes, there are some tax deductible interest involved in there, and some MI, which may be deductible as well.
Sure.
So, and then another misconception I think for the first-time buyer is that some people out there still think they need to put 20% down, and that's just not the case. We have really a dozen options for first-time buyers. FHA has always been around at 3.5% down, but they just reduced their monthly mortgage insurance premiums to compete with some of these other first-time buyer products. Mass Housing has 3 and 5% down with no MI options and built-in unemployment insurance in some cases. We still have 100% financing for veterans that qualify, and for USDA rural development properties that fit into that category. And then finally, early 2015, I mentioned we started to see some of that common sense come back to the market here, and we've seen Freddie and Fannie bring back the 3% down option for the first-time buyer. So, you know, we're making it easier for the first-time buyer to come in with less down payment.
If somebody has a low down payment, only has a low down payment, are they looking at paying significantly higher interest rates on their mortgage?
No, but the mortgage insurance piece does play into that. So anybody that does not put down 20% will have mortgage insurance in one form or another, whether they pay it monthly, whether they have the lender pay it. The seller can pay it in some cases. So there is that piece of the mortgage insurance, which is based off of the combination of their down payment and their credit score.
And that can be a significant portion of their monthly payment.
It can be, but you know, everybody's different. Everybody's situation's different. So, you know, I'd say talk to someone, look at credit, and sort of see what those numbers look like for you.
Okay.
You may be surprised at what we can do.
Sure. And then I think again, those first-time buyers are in a comfortable situation. They're in a rental situation, and we know the rental market is very tight, and rents are going up.
Sure.
And I think that anyone who is in any way reading what's going on in the housing market knows that housing prices are going up. So there's appreciation. I think that there may have been a fear on the part of first-time home buyers looking in the not too distant past that home values did go down significantly, and many homeowners ended up owing more on the home than the home was actually worth.
Absolutely. I think in the last couple of years that has been a really big concern, is that what if I buy this house now, you know, in a couple of years, is it going to be worth less? Are these values still going down? I think we've sort of started to see the bottom of that late last year, and now we're starting to see that, you know, inventory so low, demand so high, is starting to, you know, bring these prices up a little higher this year.
All right, and one component of qualifying for a mortgage on a specific piece of property is an appraisal on the property.
Sure.
Now, have you seen issues in the housing market now where the appraised value of homes have not kept up with the market itself?
No, I think, you know, the appraisers are doing a real good job of sort of seeing what's out there in the market for comparables, and you know, I haven't seen appraisals coming in low, and I don't think we've had you know, too many issues with you know, homes going above sales price but then not appraising. That's always going to be a concern as the demand for the homes sort of inflate the prices, whether or not the appraised value is going to support that. And we seem to see that that's holding out so far.
I think early on in the crisis that was a problem. I think that appraisers were very cautious because they had appraised property and the values had gone down. So that seems to have been more of a problem in the past than it is today.
Absolutely true.
So let's just skip a little bit to people with more of a down payment on a property, in a position to put more money down. It's a competitive market out there, sometimes multiple offers on property, and people are bidding up property above the asking price. And so in that situation, you could have a situation where the appraisal doesn't support the value of the house. So that doesn't necessarily kill a deal.
It won't. I think we're starting to hear a lot about an escalation clauses and different things that the attorneys are putting in to get, the offer, a little bit more strength. And so we have situations where, if you're putting 20% down, they might put a clause in the P&S that says if the appraisal comes in low, the borrower will pay the difference, or different things that will assure the seller that if the appraisal doesn't come in, the deal will still go through. So there are different ways to sort of set up the transaction so that if that were to happen, there are ways to sort of keep the deal together.
What about putting more money into the deal? Is that?
Sure, absolutely. I mean, the more you put down, the stronger I think your offer is going to be with the seller and the listing agent. So that certainly helps.
Certainly helps. Okay. All right. So now let's move to some changes.
Sure.
In the principal document at a closing is a settlement statement, and we've talked on this show about all the documents that are placed in front of a buyer
Sure.
at a closing, and the buyer is often a deer in the headlights. You
Sure.
just tell me where to sign. And there is some concern, and again, this goes back to the Consumer Protection Finance Board and wanting to be sure that consumers are fully informed of what they're getting into, not necessarily that anyone is up to anything, but that you really should know. And they're looking at numbers at a settlement statement that may not be the numbers they saw when they applied for the loan. So tell us what's going to happen August 1st,
Yeah.
and how it's different from the past.
So August 1st, we're couple big changes coming down for our industry, and it really will affect the lenders, the realtors, and the attorneys. One of the big changes is, as you mentioned, at closing, the client gets a disclosure called the HUD-1 settlement statement. The problem is that HUD-1 settlement statement looks completely different from the forms that the borrower gets at the beginning of the application process. So they get a form called a truth in lending and a good faith estimate. And those forms look nothing like the HUD-1 form at the closing. So that can create some confusion when the client sees numbers in one format at the beginning and then a completely different format at the end.
Right, and the HUD, I've been in real estate for over 30 years, and that HUD hasn't really changed in 30 years. And hasn't kept up. So now it is going to change.
Yep, it is going to change on August 1st. We're going to change and get rid of the TIL and the GFE and replace it with
The TIL is?
The truth in lending form and the good faith estimate that you now receive from the lender at the application process is going to be replaced by a new form, a new application disclosure form, and it is going to match exactly the closing disclosure that you get at the closing. So they're getting rid of the HUD at the closing, replacing it with the closing disclosure that exactly matches the format that the client will see at the beginning of the process. And this should really help cut down on some of the confusion.
And one aspect of this new regulation is that this new form is given to the borrower or the buyer at least 3 days before the closing?
3 days. So I'd say typically right now the borrower is getting that closing disclosure 2 days, maybe even 1 day before the closing, and there's not a whole lot of time for the client to review and absorb and sort of digest all the information and make sure that it sort of matches what was disclosed at the beginning. And so they're going to put in place a 3-day waiting period by which the final closing disclosure is disclosed to the client, and then they'll have 3 days before closing which no changes can be made to that document, and they'll have that 3-day period to answer any questions, get all the information that they need so that when they sit down at the closing, they've had plenty of time to review the document, they know everything they're sitting down to sign, and I think that's going to be a really great change for the client. It's just going to slow the process down a little bit at the end, take a lot of the anxiety out of the end of the process, and I think it's It's going to be a good. It's all going to be an adjustment for us all on August 1st as we sort of move through these new changes and make sure that everybody's sort of following the letter of the law. But as long as we know it's coming and you're working with a lender, realtor, attorney who is sort of on top of these changes, then I think it should be a good
So
change.
one recommendation that I've heard lenders anticipate making to a buyer is bring your checkbook to the closing. Now, they're obviously not going to pay their down payment from their own checkbook, but why would they bring their checkbook to
Well,
the closing?
the way it's done now is certain adjustments to, let's say, prorated water and oil from the seller. If there's some oil in the oil tank, you may be required to write a check to the seller for what's left in the oil tank. And usually those water and oil adjustments happen, the last day, the day before the closing, they go on the HUD. We're still waiting for clarification from the CFPB as to whether or not those items are going to be something that can or can't be added during that 3-day period, but it's possible that those items which previously were handled on the HUD may be handled outside of the HUD separately.
So we're talking about relatively small amounts
Small
of money,
amounts,
but
sure.
nonetheless would represent a change in these documents that we've talked about and could trigger this an additional 3-day waiting period.
Which would sort of push off that and any other closings that are tied to that. And so I think if everybody's diligent and sort of getting everything done about a week early, it should be pretty seamless.
Well, Jeremy, thanks very much for being here. You've been
My
very
pleasure.
informative.
Thank you very much.
Okay, great. And that's our show for today. Thanks for watching.